Will Papa Pow rock the boat this afternoon? The European Central Bank meets this afternoon to decide the fate of the euro, as well as good news actually means bad news. All coming up right now. Good morning on this beautiful Thursday morning, the 8th of September, guys. I am your host, Dane van der Must, and in the next couple minutes, we're going to be spending a ton of time together. I have been extremely excited to put together this show for you guys because we have some very interesting topics that I would love to discuss with every single one of you. It's going to get interesting. Sit back, relax, hold on tight. We're going to go over a couple things that are immensely important. Now, we may skip the timeline today because the things that I'm about to show you will really open up and make you understanding of what's happening in this world right now a little bit clearer. So without further ado, let's just jump straight into the news. And there's this beautiful article that could not have been timed any better that gives us some perspective as to what is happening in the world right now. So without further ado, let's just jump straight in and let me share with you. Now, guys, first and foremost, before we continue, guys, go ahead, make sure you like and subscribe on our YouTube page. Follow us on social media. There's a ton of new content coming out there. And at the end of this, if you enjoyed this content, please leave a comment. Let us know what you think specifically on this topic because it is controversial. I would love to know your thoughts and opinions. But for the longest of times, people have been asking, what is happening in the world? Why is it that when we get the positive data, do we see that, markets react opposite? And there's a beautiful article that's come out this morning that really highlights, what all of that essentially means. And I'm going to go over that in the next second with you. And it really should help to cement your understanding as to what is busy happening in this crazy world we're in right now. It has never been a better time to be a trader and to be involved in the markets. So the title is How Good News is Actually Bad News and How Bad News is actually good for the markets. Now, we've been seeing this, right? As stock markets increase, right, the Fed has tried to rise interest rates. And just to have a quick crash course on what that means, raising interest rates is an attempt to reduce the amount of spending, the amount of money in supply, because ultimately too much spending, too much growth leads to inflation. The word inflation is a big talking point. It'll continue to be a massive talking point around the world as each country, each bank is trying to regulate the amount of inflation to avoid super or hyperinflation. So raising interest rates is an attempt to calm the economy down to avoid a full-blown recession. So I'm going to share this article with you guys, but ultimately when the stock markets are rallying, when Wall Street, we've always known that Wall Street and Main Street are disconnected. When Wall Street is doing, all of these massive gains, looking unaffected by the economic events of the world, this looks bad for, in this particular case, most of the Federal Reserves because they're trying to curb this growth. They're trying to curb, this expansion in the markets to slow it down and to bring things back to normality. So I'm going to share this article with you, and I think you're going to have a really good read on it. However, I have prepared something that I really would like to share with you guys this morning, and it's a little bit of an insight as to, what I've been looking at to try and just better understand, what it is that we're busy going through, right? A recession, a contraction, a correction in the markets is something that's happened many, many times over, right? 50, 60 times in the last century. Now, there are common signs in terms of what happens, and there's certain normalities, there's certain rules that we can expect to see. However, the news won't play it this way. The news will create gloom and doom. The news will create fear, or inversely, in order not to create fear, they would say, hey, everything's fine, everything's under control. Meanwhile, they know the data, they've got the data, they can see it's there. And that's why it is an amazing opportunity to be a trader. Never mind just a trader, but a trader with Globex 360, having the ability to plug into G360 TV, having an ability to have all the assets and the benefits of guardian angels, cashback bonuses, and all these other amazing things just adds another million reasons why you are watching me right now. You are in exactly the right place. But let me get back into the charts and let me just show you what's busy going on. So what I've done here is I've mapped out, the last couple massive sort of recessions. And in most cases, this line over here, this is the SPX or the S&P 500, right? Which is generally the most stable of the stocks. I could have looked at NASDAQ, I could have looked at US 30. However, the SPX, we've got a lot more data, going all the way back to, 50 years. So in most cases, what I'm most interested in is, what happens when, interest rates get dropped, and what happens when interest rates flatten out, and what happens when interest rates rise. And there's something pretty amazing that I'd like to show you is that, dropping interest rates, the stock market in most cases doesn't like dropping interest rates. Dropping interest rates is good for the person on the street, right? Good for the end person. There's more cash available, more spend available, and it's counterintuitive to what you would think. You would think, okay, if there's more spend and credit is easily available, the economy should thrive. People should be buying more stock. People should be purchasing and consuming from more of these listed entities. But the data says something otherwise, right? And let's just carry on and let's just give it a further look, right? So interest rate bottoms, right? And very little effect. But in most cases, when interest rates rise, the stock market thrives, right? Interest rate rising and the stock market thrives. Now, again, counterintuitive. Why? Because we're told that when interest rates are being risen, it's in an attempt to rein back in this massive bull market, which causes inflation. But look at the data. What does the data say? So interest rates rise, stock markets thrive. Now I have also got in here the dollar index, right? And the dollar index tends to take a little bit of a hit. But let's move into something a little bit more recent that we will remember. And I'm going to look at the dot-com recession, right? The dot-com bubble, the massive bubble that burst there. And so on that burst, in terms of that massive move there, the S&P 500 took a massive knock. We can clearly see that, right? Interest rates started to drop. The markets did not react positively to the drop in interest rates. Once again, when interest rates got dropped, the markets struggled. And I'm talking about Wall Street in terms of the markets. The second we had that interest rate bottom, right? Markets showed the first sign of recovery, but ultimately it's only when the interest rates started to rise did the markets rally. So in the articles that we're seeing today, we're seeing articles saying, the stock market's going up, it needs to come back down. But historically, this has always been the case, okay? When interest rates are lifted, increased to meet and curb inflation and spending, stock markets have always thrived off of that, okay? Let's give it a further look real quickly. All right, so 2007, 2008 housing crisis, right? Massive bubble. Markets obviously took a massive hit off of that. Interest rates were dropped, did not immediately help the stock markets, right? Interest rates bottomed out and stock markets by themselves started to recover without any rise in any interest rates. But the second we did rise interest rates, and this was in 2015, and this is all based on the dollar, obviously, the stock market performed extremely well, yet the dollar index didn't, right? So in most of these cases, there's an inverse effect. Have a look over here, right? Interest rates bottomed out, The dollar didn't do extremely well against all competitors, but the stock market did, right? Then if we go to what has happened now most recently with the pandemic, right? Pandemic hit, we had an immediate and very sharp fall off in terms of market price. Interest rates were dropped. Markets obviously didn't react positively towards that from a stock market perspective. But the second those interest rates were at their bottom, absolute low, stock markets started performing once again. Now, for the first time, we're seeing interest rates being risen and the stock market is underperforming, meaning we aren't seeing that same rally that we've seen in the past when interest rates historically have been risen. Now, all the articles point to the fact that, markets that are busy rallying shouldn't be a good thing. Right, in a typical situation when a stock market rallies, this is good because investors and savers have a little bit more money. But this article saying the bad news is that because there's excess economic growth, they're basically giving the Federal Reserve more reasons to further escalate interest rates. Okay, but look at the data. The stock market is not rallying, right? Since the start of the crisis, start of the pandemic, stock market has had the worst 6 months in history. Okay, so there's definitely something cooking. There's definitely a disconnect between what it is we're reading, what economists are busy saying, and just the pure data that's on the chart. And I found this extremely interesting because, this article that I'm about to send you guys says that, when the news is good, it's actually not necessarily great for the markets. When news is good, it's actually bad. And when there's bad news, it's good because it means that the Federal Reserve will have a more dovish approach. Dovish approach meaning have a less aggressive approach to ramping up those interest rates. But have a look at the data. The data says something completely different. Okay, so I just wanted to share that with you. This will become its own video completely. I'd like to deep dive on that, all of the events, what happened. There's obviously a lot more factors to consider. There's factors like unemployment, there's factors like GDP. There's a lot more contributing factors that leads to this. But the general trend over the past 5, 6, 7, 8 recessions have all been pretty much cookie cutter, exactly the same, except for this one. Okay, now a lot of people could say, well, maybe the oil crisis, it may be a bunch of other things, but ultimately this is very interesting. So let me know in the comments what you think down below, and just your opinion. I would appreciate that. Now, moving on really quickly, we have quite a bit happening today, right? As I alluded to in the beginning, we have the ECB meeting that's going to be happening today. Interest rate decision is due at 2:15. So today we will be having a special broadcast. We will start the broadcast earlier. And as you can see, at about 3:10, we also have Powell speaking, right? Papa Powell rocked the markets in the last 2 weeks with his change from a dovish to a hawkish approach. So I think this afternoon, over this course of this hour, we're going to see some crazy volatility. So what we're going to be able to do this afternoon is I'm going to dive a little bit deeper into analysis. We're going to have an hour to look at charts, to look at pairs, and I invite you, if there's something you would like to see, if there's analysis, if there's an instrument, if there's a trade, if there's something that you see, kindly send that through to me and I'll include it in the broadcast, give you a shout out, and we will break it down together. But what does this mean in a nutshell really quickly, right? Currently, the European Central Bank has a forecast of increasing the interest rate by 75 basis points. So initially, they're currently sitting at a 0.50, 0.5%. They're looking at increasing that to 1.25%. However, there's a little bit of a 50-50 split here, right? Half the market believes that there will be a 50 basis point hike, whilst the other half of the market believes that there could be a 75 basis point hike. Well, you might be asking, Dane, or what does that mean? And I'm going to show you in a second. So a 50 basis point hike means a fairly soft approach to the market, right? Markets want to see strong action, strong leadership to curb rising inflation and rampant pricing of foodstuffs, of just general commodities. That's what inflation does, is things just cost more and more and more, or the economy or the currency for that economy buys less and less and less. Either way, it's a net zero game. It's not a good thing. So this afternoon, we are going to see whether we are going to get that 50 basis point hike for the euro, or we're going to get the full fat 75 basis point hike. And that is going to have a massive effect on the euro. Now, quickly just moving on and having a look at where we're currently sitting on the euro dollar. The dollar is still looking super strong, right? And I know I've completely ignored the bottom timeline, so forgive me for that, but we will have time this afternoon to get at the live session. The live session will be starting at 2 o'clock this afternoon, GMT +2. So we're starting just over an hour and a half earlier. We want to catch that ECB meeting. We want to catch some trades. We're going to trade live. You don't want to miss it. You want to be a part of that. So dollar is extremely strong. Euro USD is temporarily just poked outside of that massive low, right? Showing a little bit of euro strength. It's definitely not dollar weakness, but euro strength. If we get a 50 basis point hike, that is not strong enough. It's not a strong footed enough approach on the euro to have that continued strength on the euro. A 50 basis point increase could send euro USD into the floor. Okay. In addition to that, we have Papa Powell speaking again, and that is at 3:10. He rocks the markets, as we've seen. So that's going to be a very interesting play, looking at what's going to be happening on the dollar. And a few minutes after that, we have New York Stock Exchange open. So today is going to be an extremely powerful day. You do not want to miss that out. There's never been a better time to be a trader, to be a Globex 360 trader. Pretty much more than anything else, guys. As always, if you've found this video informative and you've liked it, go ahead, like the video, subscribe to our channel, hit that bell notification item so you never miss a brand new upload. And I will be live at 2 o'clock this afternoon, GMT +2, as we cover and discuss a ton of these items that are busy happening within the markets. Guys, it's been an absolute pleasure. As always, be safe, trade safe, and as always, do things the Globex 360 way. Much love.